market right here on ET now and still holding through, although you'd have to say that slight bit of gain that we were sitting on earlier has fizzled out completely. So we're sub that 11,100 mark and lying absolutely flat in trade. The breath, while it continues to favor the advances, that is somewhat ebbing off as well. Motherson Sumi, an Andhra Bank, a KPIT, ITC and Suzlon within the liquid universe are some of your losers. But it's focus NBFCs, and like we were talking about, it's important to get in an outlook on NBFCs post the recent fall. What's the view on NBFC valuations? Is this correction a good time to buy in? Let's try and understand how to approach the segment. Nidhesh Jain, research analyst at Investec Bank, joins us on the show right now. Nidhesh, hi, morning. Thanks so much for joining in. You know, the question in everyone's mind is if Bajaj Finance falls from 3,000 plus levels all the way to 2,100 or what have you, does it become a buy already? Would you recommend that selectively one should buy this decline on NBFCs, or is it still time to be a little wary?
Yeah, so if you look at what has happened in last 2 weeks, one of the bigger concern for NBFCs is their funding profile. We have seen that some of the NBFCs have become very large without support of funding availability from the economy. So I still continue to be quite cautious on the large NBFC segment, and especially the NBFCs where there is no strong parentage, because the availability of funding may get constrained for those companies, and their cost of funding as well as loan growth may come under pressure. But having said that, in that scenario, some of the smaller size NBFCs where parentage is very, very strong, we can start selectively buying those NBFCs from here onwards. I will not suggest that we can go out and start buying them aggressively, but selectively in a smaller way, we can start buying the small NBFC space with very strong parentage, very strong with a 100% sort of retail asset book. And mind you, some of the NBFCs are also having funding from a fixed deposit from our retail investors. Those NBFCs also have a fairly diversified funding mix and unlikely to see material impact on their growth in this tough environment on the funding side.
But do you think that, you know, post this correction, one perhaps has seen an adjustment in valuations, and also the fact that you know, this is as bad as it can get and not beyond?
So it's very, very difficult to assess the quantum of the problem. But historically, if you look at, I have been covering the sector for last 7-8 years. Historically, we have seen 2-3 crises for NBFCs. First was 2013, where interest rate shot up very quickly during August 2013, and there was a lot of question mark on the sustainability of wholesale funded NBFCs. The NBFCs came out pretty strongly post that crisis. Second was demonetization. Again, during that time, there was perception that NBFCs are financing segment with poor credit standards and are mostly collecting in cash, and hence they will get impacted severely. There was impact on their profitability for a couple of quarters, but again NBFCs come back very strongly post that. So now again there is a big scare on the NBFCs availability of credit. Here what I will say, one big difference which has happened in last 3 crises is that the dependence of NBFCs on the corporate bond market has increased substantially. In the CP market, almost 30% of the Indian CP market is invested in NBFC sector. In terms of corporate bond market, almost 20% plus of the total corporate bond outstanding are from NBFC sector, which was not the case 3 years, 5 years back. And hence there was not big constraint on liquidity position of NBFCs, because majorly they were financed by banks. But now, because debt markets are getting very cautious on the NBFC sector, so especially the NBFCs which are having large balance sheet size may face growth issues. So I will not say that there is nothing to worry about, but it's not that NBFCs are, the sector is going away and there will not be any NBFC after 1 year or after 2 years. NBFC sector, which is definitely required. There are segments where banks are not able to operate. But we have to selectively pick NBFCs which have very strong parentage. I think 2-3 filters that we need to figure out. One is strong parentage, diversified funding profile, and if they have a deposit taking license, that is a plus point. And third is predominantly retail asset book, because still whatever credit quality issues we have seen in the NBFC sector, it's mostly in the wholesale infrastructure segment. NBFCs operating in retail asset segment have done phenomenally well on their asset quality. So if we go by these 3 filters, there is still handful of NBFCs available at very cheap valuations and very strong balance sheet positions.
Where do you think the opportunity lies within NBFCs as well? You know, whether it is the housing finance business, auto financing, conglomerates, where do you think the revival will be the fastest?
Yeah, so I will add one more filter to this, is the size of the NBFC, because as the size of the NBFC increases, definitely the fragility of the business model also increases, especially if the parentage is weak. So, so these are the 4 filters. In addition to that, if we look at, there is one more very interesting space which has emerged, and probably market will start rewarding banking license quite positively after this event. So small finance bank, which were predominantly NBFCs before 2016, has emerged, and those entities have been able to show very good traction on liabilities. There should not be any impact because of funding constraint in the corporate bond market. For those guys, they are actually paying back their corporate bonds and replacing them with retail liabilities. So in that space, Equitas is a stock which has also got hammered down during this correction, and is available at very cheap valuation of around 1.6 times FY20 price to book. We expect very strong improvement in profitability as well as very strong growth. In addition to that, they are carrying excess liquidity of around 2,200 crores on their balance sheet, and in a rising interest rate environment, they are one of the best placed small finance bank. So this is one stock that one should definitely look at. Among NBFC sector, I will go with very strong parentage in the vehicle finance, which is Mahindra & Mahindra Finance and Chola Finance. These are the 2 entities which one can look at buying them selectively. Auto sales continue to be pretty good. The growth guidance of these companies continue to remain very strong. They have diversified funding mix. Mahindra Finance especially also has a fixed deposit franchise, which is pretty strong. And in the housing finance space, I will stick with the small size housing finance company, especially in that segment. Canfin is one stock that we have been pushing, that has corrected very sharply from its peak. It's small in size, AAA rated, backed by Canara Bank, and hence we expect that it should not face funding issues, though there will be some pressure on margins, but growth should be revived. And in case there is growth issues for large housing finance companies because of their size and funding constraint, the small HFCs should do well. So these are the 3-4 stocks that we are continue to remain very bullish on.
Okay, Nidhesh, thanks so much for giving us all that perspective on what really to do with NBFCs, given the kind of fear in the market about this liquidity crunch, and whether or not to buy them in this current decline or not. Good speaking with you as always. But let's shift